Welcome to the Scaling SaaS podcast, sponsored by Zeno Digital Consulting Group, where we talk with founders and operators about building durable, scalable businesses. My guest today is David Trainer, founder and CEO of New Constructs. David comes from the institutional investing world, and his work focuses on understanding the real economics of public companies, not just the surface level numbers most investors rely on. We're going to talk about where traditional financial analysis breaks down, how New Constructs approaches that problem differently, and what founders and executives can learn from that way of thinking. David, welcome to the show.
Thanks for having me here, Brad. I am excited to get going.
Yeah, I've been looking forward to this conversation ever since we had our short phone call. So why don't we just get started with you? Just why don't you just give us a little bit of an overview, the audience a little bit overview of what New Constructs is, and what makes it different.
Yeah, at our core, we're a research firm. We focus on stocks, and a little over 20 years ago, I left Wall Street to build technology to do what I saw, the Wall Street analysts weren't doing anymore, Brad. And that's like reading the fine print and all the filings. They were doing it before the tech bubble, but when the tech bubble hit, it was like, what are we doing that for? We can make too much money doing other things. And so that was a real motivation for me to go out and create a better system for compiling data from financial statements into models and signals. And that's what we do, and have been doing for the last 20 years. I'd say we've done it pretty well. There are three indices that are provided by Bloomberg that take advantage and leverage our data. And the biggest and most popular one is the Core Earnings Leaders Index. That was up 27% last year versus the S&P at 18%. And the strategy is entirely based on our better measure of earnings based on data we get out of Footnotes that nobody else has.
And so let's dig into that a little bit. So I'm curious. So on the at the highest level, you're basically saying, look, there's a lot of data out there, but like a lot of financial companies and research companies, they just don't dig in enough, or is there data that they're missing? Like why do most like where does most traditional financial analysis fail as far as you're concerned?
Yeah, it's a great question. And one of the biggest pieces of pushback I've gotten over the years, especially when I started the business, was why are you doing this? Isn't that what Wall Street does?
Right.
And so people don't understand that oftentimes that there's a real disconnect about what Wall Street is doing and not doing. And what people don't realize is just how compromised Wall Street research is.
Hmm.
Let me start with a simple question. How much money do you think Wall Street research analysts generate for the firm, whether it's JP Morgan or Goldman Sachs or Wells Fargo? How much do you think the research analysts, how much profit do they bring in?
Like not having even an inkling of a baseline. I have no idea what that would look like.
It's a cost center. They lose money. You want to know how much revenue they bring in? Almost none. So
Negative.
where do these big firms make their money? Investment banking, right? Which is
Right.
another way of saying helping companies sell stock. Do you think companies will choose an investment bank to help them sell stock if the analyst covering the company is negative on the stock?
Mm. Yeah,
So I
good
saw this
point.
firsthand at Credit Suisse, and it's part of why Wall Street was fined over $1 billion after the tech bubble because there were analysts, Wall Street analysts, getting paid directly for IPOs, which was supposed to be illegal, but they were doing it anyway. And it was really the only way to kind of keep those analysts around because everyone knew how much crazy money they were making during the tech bubble. For example, the big Elliott Spitzer settlement after the tech bubble, the biggest settlement of all time against Wall Street at the time was $1.2 billion. Wall Street firms made that much in a week.
Yeah.
So big money to everybody else, small money to them. And when I say small money, the bankers are making hundreds of millions of dollars per deal. And so you think an analyst is going to come along and say, well, I don't think it's a very good stock. I have a sell rating. You know what happens to analysts that do that? Heads chopped off, right? They get
Yeah.
fired. I saw it happen to one of my good friends, Mike Mayo, the bank analyst, was negative on banks. They didn't like it. They got rid of him. You can look it
Hmm.
up. You can look it up. It's the stories about that on the internet. So, um, Wall Street's not doing this work. They're not paid to do this work. In fact, Wall Street analysts are paid to help the bankers sell deals. They don't sell deals, the firm doesn't make money, right? So Wall Street analysts are compromised. That's what we pitch to our clients. Like, you don't have to be compromised like a Wall Street analyst. You don't have to help the bank sell deals. You don't have to listen to that propaganda. Use research that's getting to the truth. So I had a front row seat to all this stuff during the tech bubble, not just during the tech bubble, itself, but like seeing how deals got done and figuring out that bankers could find a profitability metric or ratio to make any deal look good. And so I got out to kind of to create a technology to serve as an antidote to all that.
I do want to dig into that technology, but I just want to touch on a couple more things. I'm just curious about it. So when I go and I look at, reported earnings, how, what am I looking at what am I missing? Is the data not there? I mean, how often, why does it kind of, a lot of times when you look at reported earnings, it kind of fails to reflect, just the reality of economics and the situation. So like what is it about the reporting earnings that's missing?
Yeah, the big thing that's missing is analysis of the footnotes. So there are a lot of legacy data providers out there that have been collecting data from financial statements for decades, and there are lots of studies showing how that data is compromised, how it's not very good, and there are specific studies comparing our data to that data, and what those studies tell you is that the legacy data providers are missing footnotes. Let me explain to you why they're missing the footnotes, Brad.
Yeah, I was
This is
gonna say, let's dig into that because that's it's really interesting to me.
This is a below average 10K or annual report, below average size, right? So footnotes, I'm sorry. So financial statements, they take up about 1 page, right? An income statement doesn't really need more than a page or two. You got your risk disclosures and some of those things, right? There's a balance sheet, right? That fits mostly on 1 page, right?
Yeah,
You don't really need more than a page. So you got 3 or 4 main financial statements. That's 4 pages. You got risk factors. So and other legalese stuff. So maybe it's 25 pages, which is the
yeah.
length of most filings when I started in the business. But this is like 200 pages. That's 175 pages of footnotes on a 200-page filing. So, and if
Hey,
you read any financial statement, you look at any income statement, Brad, at the bottom of every single one says you need to read this financial statement in conjunction with the footnotes. The problem is people don't read the footnotes.
I mean, is it really that simple? I mean, is it just you're paying attention where others are not paying attention?
It is that simple in concept. In practice, it's
Sure.
difficult, right? These footnotes are long. They're dressed up in a bunch of legalese and complex
They're they're
financial
probably
disclosure.
interrelated. One footnote relates to another footnote. I'm sure it's incredibly complex.
There's repetition. There's stuff in there from prior periods. I started reading footnotes in 1995, and it became clear to me right away that companies are not in the business of telling you the truth about their profits. They're in the business of obfuscation. Because if they weren't, these filings wouldn't be 200, some of them are 2,000 pages. If they weren't in the business of obfuscation, XBRL would work. XBRL doesn't work. Anybody who's familiar with it will tell you that companies change tags up all the time and they invent new tags. And so, look, Wall Street and corporate America make a ton of money selling stock, a ton of money, right? I mean, look at all these big IPOs that have since gone, close to zero or do go to zero. And WeWork is one of my favorite examples. They originally wanted to IPO that thing for $45 billion, Brad.
Yeah, it was. I knew it was high. I didn't know the actual number though.
Yeah, they're like literally coming out like, "Hey, here's a great company. It's worth 45 billion. Retail public, stock market, write
Right.
us a check for $45 billion valuation." Right? A few weeks later, the IPO got canned and SoftBank wrote it down in their own books for 4 billion in just a few weeks. So for you, 45, for me, 4. Eventually got marked down to 100 million, I think, or something. And eventually kind of came out through a SPAC and that SPAC went to zero. I mean,
Mm.
So it's just a good example of just how much Wall Street is willing to fool people in order to line their own pockets.
So then all right, so let's get into new constructs. So how do you solve that problem? You've already touched on it at kind of high level. Let's get into a little bit more detail.
Yeah, so our AI is not some fancy pixie dust and an algorithm figures it all out. We don't just, you know, dump a bunch of filings into an LLM model. Not that at all. So my original technology at New Constructs was really a pretty simple piece of software that took a digital version of the filing and a parsing tool in the database and a model and put them all together so that we could have analysts go through and collect data from the filings into specific buckets in the taxonomy that drives our metrics and signals.
So
So
you essentially turn a bunch of unstructured data into structured data.
exactly. That's what you got to do. You have to structure it into a taxonomy that feeds an ontology that hopefully produces value. Ontology is just the meaning behind the taxonomy, right?
Mhm.
And so, for people in the stock market, your ontology is to pick stocks better than the market, right? That's a hard thing to do. So you have to decide, okay, well, what's my taxonomy of data? How am I going to organize the data to produce a signal to beat the market? And then that taxonomy has to be faithfully populated with data pretty perfectly, or it's going to be get stuff wrong, right? So I had the ontology and taxonomy in mind, and had a very specific bucket structure for all the data to populate the taxonomy. And I taught people very diligently. It took 6 months of training before I let somebody touch a model, right, and or a filing, and so they diligently were populating these things, and then we'd look at the model results and we'd share it with some of our institutional clients who are really smart folks, and we just kind of made sure we got it right slowly. In the beginning, we covered like 50 companies, then we could go to 100, and there's only 5 years of history. Right. And then I remember a couple of years later, we made a big push to get the S&P 500 and 5 years of data. And now we cover 3,400 stocks with 20 years of data, you know, or more oftentimes. And but over time, as the machine was tracking every single item that was parsed from the filing into our taxonomy, we could go back and say, okay, we've done this 10,000 times. Machine, can you do it on your own? It's like, yeah, I've seen that, human do this, and it can start to recognize the patterns. And if it wasn't sure, always ask us, and we give it the answer. So slowly but surely, we taught the machine by basically programming the machine to do what experts do with a ton of iterations, tons of training data. And we've since done that on 250,000 filings that experts have marked up themselves, and humans, just pure human sort of investment. And then, millions of filings when you count how many times we've been able to use AI to say, hey, AI, go parse this filing, and then grade yourself against how the human did. Tell us what you got wrong and why.
Mhm.
So that kind of data and training data is super valuable. And there's no easy way to get stuff like that, Brad. Like, that's what I think people don't get. It's like, wait a second. Teaching a machine to do something really complicated means putting it all on paper, putting it all in code. Like, there's no secret weapon to get a machine to understand what's in a really smart person's mind. Shoot, people write books on that kind of stuff, and still some people don't get it. We expect a machine to do it. No, we had to do it very deliberately, company by company, line item by line item, until there was enough instruction for the machine to take over.
And how do you choose the companies? Are these from clients that you have, or are you building your own database based on just, your analysis of what companies you feel like you need to run the machine on?
In the beginning, when we really kind of scaled up, we covered the Russell 3000. And then we started a hedge fund. And I realized about 1,000 of the Russell 3000 were uninvestable because they were so small and meaningless. Excuse me. They were so small and meaningless, and had such little volume that it's kind of like, why are we even covering these? And our hedge fund was small. I don't think we got over 15 million dollars, 15 million in AUM, right? And those stocks are too small. So we don't cover the Russell 3000. We cover 3,400 of the most actively traded stocks in the US. That represents about 99.99% of the market cap in the US. There's a bunch of other small stocks. So we're really covering, I think, everything that matters. Clients have requests, we'll add it to coverage. That's
Sure.
today. Now, our number one goal in 2026 is to cover the rest of the world. Like we're ready to scale to cover all non-US exchange traded stocks.
So the similar strategy, just go for the top traded stocks in each of the different, in Japan and those areas. Interesting. And is that so? What prevented you from scaling beyond US? Like why 2026?
Yeah, no, it's a great question. I'm a friends and family run firm, so we've never been capitalized like some of these West Coast firms that that someone drops 200 million on them, on day
Yeah.
one or 30 million, right? So we've been doing this carefully over time, proving the concept, believing that if we build it, people will come, and and really honestly believing in the integrity of what it is we're doing, and believing that the integrity of the capital markets would recognize what it is we're doing. And so we couldn't move that fast, right? A good friend of mine who's in construction, he says you can have good, fast, and cheap. You only get two out of those three, right?
Right.
So we're good and cheap in terms of low capital required. But now that we've proven the concept, now that we got the stock picking track record, now that the indices based on our data crushing the market, and we've got 56 straight months of being the number one ranked stock picker on some zero. And then we've got the automation to the point where it's doing 98, 99% of the work on all the filings. We're like, okay, time to scale this baby.
So when, the sky is falling, folks, when they start talking about AI and they're like, it's gonna take all the jobs and all that stuff. I mean, what you're describing is could take jobs away from analysts, right?
Yeah, I think absolutely. I did a guest lecture at Harvard Business School last November on how AI was affecting investing, and I told the students like, listen, there are going to be a lot fewer jobs for you guys if you want to be a portfolio manager, and I think it's a
Right.
good thing. I had a meeting earlier this week with some I don't remember who it was with, but we were joking about how the mutual fund industry might be the biggest grift in the history of mankind. When you
Oh,
consider how much assets they've had under management and how they underperform mutual funds, 80% underperform the market in any given year. Less than 1% outperform over more than 3 years, right? So they're taking your money and underperforming and charging excess fees. It's absurd. It's absurd, right? And the only reason I think the mutual fund industry is still around, it's not all gone to ETFs, is because of capital gains tax. People don't want to have
yeah.
to realize all these terrible capital gains. They're like, I'll just leave it there. I just met with an advisor this week who's like, yeah, I'd love to move a bunch of money over, but God, it's capital gains. So anyway, yeah, I think we should probably lose. We could stand to lose all these portfolio managers getting paid to underperform. And
Where does
so
human does human judgment come in? Like where do you provide that? I mean, obviously there's going to be a lot of, a lot that the model's going to be doing. And so where does a human come in new constructs?
yeah, let me if you don't mind, can I share my screen?
Yeah, actually I've never done that on the podcast yet.
Yeah,
So
here we go. So
this
this is a slide that
uh,
I used with Harvard Business School, and is this working for you?
yep.
Yeah, great. And those meetings and some other presentations I like to do, and because I think it's important to understand that AI has to learn, in some ways, like a human learns, right? You start with the easy stuff, and then you get harder, and you do advanced modeling, right? And then you can generate novel alpha. And when there's automation that does all this, well, then that's when you get AI, right? And so humans were involved on financial statements a lot, Brad. Now, I don't know if we look at 1 in 100, but when an anomaly comes along that the system has never seen before, we got to come in and fix it, right? And again, it goes back to that statement I made about obfuscation. and companies obfuscating, and that means that you're going to see income statements that are just messed up sometimes. I mean, we see income statements that don't add up and don't balance, and balance sheets that don't balance.
Well, that was actually kind of gears to my next question is like, what's the danger? Like, I'm sure you're getting in a ton of data. And so, is there a danger in confusing more data with better data?
Absolutely. That's, I think, one of the biggest problems we have in all of society. It's like, instead of understanding stocks, I'm just going to invest in more of them and hope that diversification will
Right.
will solve my problem for not doing diligence. Right. That's part of why the scaling of this technology, I think, is so important. And I think the same is true that for in most AI. It's like, oh, I just need more data, and that's just so far from the truth. What we need is quality data,
Yeah.
super high quality data, curated in a way that a machine can understand it. And that means taxonomies and ontologies, right? That are designed to fit inside a machine, to be communicable to a machine. And I would submit to you, Brad, that this is a task that very few humans have excelled at. And this is precisely the place where humans are going to be most important for AI to make this kind of leap, right? So, coming back to my chart here, in the beginning, footnotes, humans were involved a lot. I mean, I did all of the work to sort of tell people what the taxonomy would be. Advanced modeling, I had a lot of help using advanced modeling to figure out how to get alpha out of the data. It's the Harvard Business School people, Ernst and Young, people on our team here, and then Bloomberg helped us put together this core earnings leaders index strategy. But now it all works automatically. We send Bloomberg a data feed every day, right? It updates the holdings and the index and the fund, and bam, it's done. And that's then why Google chose us to build an AI, because we've got an automatic system. And this is where I think, our AI is unique. It's like this AI works. It predicts stock prices. That's something you can't say about, I think, many other or any other AI.
So Finsights is your product. Is your AI stock picking kind of AI is basically where what Finsights is. Is that fair?
That's fair. That's right.
So what is one signal that you think this is maybe not necessarily financial, maybe this like downshift into running a company now, David. So what do you think one signal that a lot of leaders tend to overtrust?
In what? In technology and AI or just
Eh,
generally?
in running the business, so, like, you've brought this from kinda nothing. You've been able to scale this. You're about to expand into Europe. I mean, you obviously have a lot of familiarity with running this company. For other founders, CEOs, executives. I mean, a lot of times we narrow in on something that might not be, the right signal to look at. We're trying, we've got so much noise. We're trying to pull the signal, but we kind of land on the wrong one. I mean, is there anything that you can think of that might, that you relied on, that was really benefit to growing new constructs?
Yeah, absolutely. The initial feedback from our initial customers. So we had Fidelity, Janus, TIAA, CREF all signed up to be customers of New Constructs before we launched. That's how I was able to raise money as never having been a CEO and start a business, before I was 30 years old, right? So, that was hard to do, and so I had letters of intent signed by those guys. And I thought that was gonna be enough to get us going. But, after that, there was really a big drop off. And I found that no matter how high quality of the product, you're the tree falling in the woods that nobody hears if you don't have a major sort of platform, marketing platform, and distribution platform behind you. And that's part of why we've stayed small. We've had outstanding product for a long time, but we've never had the capital to really drive the message. We see this happen all the time, right? And play out in reality where a lot of these really bad companies do really well because they sell a bunch of stuff or they've got capital to lose money for a long time.
Right.
Netflix is a great example, right? Like that was a money losing cash flow burner forever. But they had capital. It's so much capital it could be used as a weapon until they got enough users to get profitable.
Yeah, I mean
Uh,
that was Amazon's story, right? Same for Amazon. I mean, they were hemorrhaging money for years, but
they still
turned
are.
out turned out pretty good for Bezos.
No, it really did. No, and he truly innovated, right? I mean, that was one of those
Oh,
situations where you want free cash flow to be negative because you got somebody who's gonna earn such high marginal returns on it that, hey, man, you throw as much capital at that as you can.
so how do you get clients? I mean, do you have a sales team? Like are you, is it more of like, are you still involved in kind of business development from a founder perspective, or how are you working that now?
I really am. I really am. A lot of what we do is with partnerships. But I'm still doing meetings with clients. I did a meeting with an advisor today. We have a lot more outlets now. So, for example, we've got this Bloomberg index. It's been licensed, so there's an ETF that tracks that, so that's helpful for getting our name out there. And then there's our data offerings, which some of the largest quant funds in the world, like Goldman Sachs Asset Management, are licensing and paying us handsomely for. And then we have our website, which is basically super simple. It's green means good, red means bad. For all those people that don't really care to look through 50 pages of filings and check the footnotes and get all this data and granular data like that we give to quant funds, they just want answers delivered on a silver platter. We've got something for them too. And we've got partners that are helping me market that. And so that's how we're growing. But we're still pretty small. So we've got a lot of growth left in us. We've really focused more on the product and less on distribution and growth. We kind of thought the distribution and growth would come a little more easily, but it hasn't. Again, that's my sort of biggest mistake. We've had big deals, for example, for distribution with big firms, um, like Thomson Reuters back in the day. We spent 18 months working on a deal. 2 weeks after we closed, they fired the sales force that was going to be selling our product. Right. So we've had some interesting things happen over the years that have made it harder. Um, and we've just kind of kept our head down, perfecting the product, and we're looking forward to scaling now.
So help me understand. So I understand maybe from an individual investor perspective, like, okay, these guys have an angle that, Bob that I've been working in Merrill Lynch for 20 years doesn't have. I want to go to him. I'm going to come to New Constructs and they're going to help me pick, my portfolio and my stocks. I mean, is that a use case?
Absolutely. Right. I mean,
Okay.
let me just share the screen real fast and show you how easy it is, if you don't mind.
Yeah, go ahead.
Right. So, I mean, here's the system. Right. You type in a ticker, get an answer. So you want to know what we think about Meta. Type it, get an answer. Green means good, red means bad. It's a neutral rating. And then
Do do salesforce.com, do CRM.
Here we go. Good company, bad stock, right? So this is showing that its quality of earnings, profitability is strong, but the valuation is expensive. This is kind of why we're seeing this rotation out of a lot of these really expensive companies, Brad. This is
And
something we call for.
the SaaS
They go,
companies are just getting killed right now.
they've been overpriced. They've been priced as if AI was going to be a boom to them when it's going to be a competitor to them.
Yeah.
I don't think it's putting putting SaaS companies out of business. There's a lot. There's no way you're gonna prompt engineer an AI to do all the stuff that Salesforce does for you, right? And that's about
No,
the same is true for
I
like,
was having a conversation with a friend of mine the other day because we were talking about that exact thing, and maybe some of the really kind of, very small business geared, types of tools that are out there that are close to free, they might go out of business because you might be able to just vibe code a tiny little sales tracker for yourself, but nothing. I mean, not you can't do what Salesforce does. I mean, that is a
exactly,
proper enterprise level tool.
exactly, totally agreed. But the stock is really expensive when put through our system, and so this is kind of you get the quality of earnings and valuation, get the credit rating, that ability I'd mentioned to you before to go through to see all the adjustments. You want to see balance sheet adjustments, right? Here's a footnote and down here about write-offs that we're pulling out. And this would go for all the filings since the IPO back in 2005. So if you wanted to see
Wow.
what do we find in 2014, right? Realized losses, deferred income taxes, more deferred income taxes, uh, you know, valuation adjustments, same thing, operating lease information, you know, all these footnotes items and our ability to collect this is what sets us apart. And it's also this, you can see this footnote buried on page 83 of the filing around transaction and costs associated with acquisition. You're not going to find that on the income statement. It's this ability that got Harvard Business School to write a paper, because they could go in and audit it, Ernst& Young to write a paper, MIT Sloan write a paper, Bloomberg to create indices based on the data, and Google to build an agent. Because then the one thing about Google that I love is that they really love their stuff to be grounded in truth and data. And that's what we give them the ability to do, is ground the AI insights in data that can be traced back to the source. So you know that when you're getting this analysis of economic earning versus reported earnings, or core earnings versus reported earnings, you know it's true and right. And I think that's something that's so rare. That's the one thing I'm most proud of in New Constructs, is that we're giving people what is true and right about profitability and evaluations. And we're so confident that will let you audit it back to the source if you want. And we'll show you how other firms, other prestigious institutions have audited, like Harvard Business School, MIT Sloan, Ernst & Young, Bloomberg, and Google. And I think, that kind of speaks volumes about what it is we're able to do.
Is this is for paying customers? This is like what a paying customer
Yeah,
gets
this would be
access.
our professional subscription, and it gives you screening tools as well. So if you want to come in and say, hey, show me all the best stocks in the healthcare. I want to go pharmaceuticals. Go right. This small list. You want to know the gap earnings distortion score. I want all the best stocks in the entire sector that have a very attractive rating and a strong beat earnings distortion score. So only three.
Hmm.
I mean, most people don't know this, but something like less than 3% of all the stocks out there are responsible for all of the wealth creation in the stock market since 1927. So people out there with like buy ratings, Wall Street's got like 60% of all the stocks on that Wall Street has a rating on buy. Remember I told you they were compromised by the
Yep.
bankers, right? That's proof, right? In reality, there's only very few good stocks. And so this screening tool I think is really powerful. The portfolios tool is really cool too, because you can drop all your tickers in here and create a portfolio and track everything, right? Like, so for example, I had some meeting with a guy named Kenneth a little while ago. We put all his tickers in here. There we
Hmm.
go. We could give him a very quick. He did a really good job. Everything's very attractive. I think we were doing a screen and we just called it Kenneth Screen. Zombie stocks, right? This is a fun one, right? A lot of those stocks getting crushed these days are on our zombie stock list. We give that away for
Yeah,
free. The point is, we're going to let you evaluate what you have as what you might have in the future.
that's very cool. Very, very cool. Well, we are about out of time. Let me just ask you one last question. So, if you could wave your magic wand and you could have companies change the way they report, their performance, what would you ask for? What would you change?
I'd get the SEC to adopt a tool like ours so that there was universal access to the truth behind the numbers.
Right.
I think that could be the best and the most healthy thing for our stock market. I also think, in this all this conversation about malignant or mal AI, AI with bad intentions, right? What's the first thing that a machine or something that wants to take over is going to do? It's got to secure resources for itself, which makes the stock market a prime target, because that's a really quick way to get a lot of resources. I think the best protection against that is widespread distribution of the truth. So if we can get all the market participants access to something like new constructs, it's the best way to protect ourselves from an AI taking over the market with a big misinformation campaign. We're letting
Uh,
we're letting a lot of individuals propagandize us into buying stocks, and WeWork is one that didn't work. There's a lot of that did work. Beyond Meat, Robinhood, and Peloton, way down from the IPO prices, right? And a lot of stocks getting crushed today. Figma, another one. And if we can equip people with the truth before they make those kinds of decisions, they never make those mistakes. So that's the one thing I would do. I'd say, look, SEC, get involved with how markets ingest the data. Don't just say that because it's disclosed on page 275 of the filing, you're okay. Because that's the way it works now. As long as it's disclosed, they can get away with anything. So I'd like
Right.
for them to do a little better than that.
No, that makes a lot of sense. Well, David, man, this has actually been a really fascinating conversation. I really appreciate how transparent you've been about the product and what it does. And so, for people that want to learn more about you and your work and explore this research, where's the best place to go?
Just go to newconstructs.com, or you can follow us on Twitter, but NEWCONSTRUCTS. It's a pretty unique name. So it's pretty easy to find, but you got it on YouTube. I got tons of training videos and podcasts. We do a lot of education on this stuff because we want people to understand, how much work we've done for them. So we're really transparent about what we do because we know the technology is what gives us an edge.
Awesome. And for everybody that's listening or watching, thanks for tuning in. If you enjoyed this episode, make sure to subscribe, and we will see you next time.